When diving into the world of finance, it's crucial to understand the differences between various investment instruments. Let's start with stocks and options. Stocks represent ownership in a company. When you buy a stock, you're purchasing a piece of that company, which means you can benefit from its growth and profits. Options, on the other hand, are contracts that give you the right, but not the obligation, to buy or sell a stock at a predetermined price within a specific time frame. This means you can leverage your investment without actually owning the stock. While stocks can provide dividends and voting rights, options can be used for hedging or speculating, making them a more complex but potentially lucrative tool. Now, let's shift gears to bonds and options. Bonds are essentially loans you give to a company or government, and in return, they pay you interest over time. They're generally considered safer than stocks because they provide fixed income. Options, as we discussed, are more about speculation and leverage. While bonds are about steady income and lower risk, options can lead to higher rewards, but come with greater risk. The key takeaway here is that bonds are about stability, while options are about opportunity. Next up, we have Forex and options. The Forex market is all about trading currencies, where you buy one currency while selling another. It's the largest financial market in the world, operating 24/5. Options in the Forex market work similarly to stock options, allowing traders to speculate on currency movements without having to own the currencies outright. This means you can capitalize on fluctuations in exchange rates while managing your risk. The Forex market is fast-paced and requires a good understanding of global economics, while options provide a way to hedge against currency risks. Now, let's compare futures and options. Futures contracts obligate you to buy or sell an asset at a predetermined price on a specific date. This means there's a commitment involved, which can lead to significant gains or losses. Options, however, give you the flexibility to decide whether to execute the contract. With futures, you're in for the ride, while with options, you have the choice to walk away if the market doesn't move in your favor. This distinction is crucial for risk management strategies. Lastly, let's talk about warrants and options. Both are similar in that they give you the right to buy a stock at a certain price, but warrants are issued by the company itself, often as a sweetener for bondholders or during capital raises. They usually have longer expiration periods compared to options. Options are standardized contracts traded on exchanges, while warrants are more customized and can be less liquid. This means that while both can be used to leverage investments, the underlying mechanics and risks associated with them differ significantly. Understanding these differences is essential for making informed investment decisions. Each instrument has its unique characteristics, risks, and rewards. Whether you're looking for stability, income, or speculative opportunities, knowing how stocks, bonds, Forex, futures, options, and warrants work will empower you to navigate the financial landscape more effectively.